Imagine a single company wielding more economic influence than nearly every nation on Earth. Not through military might, not through political decree, but through ownership, quiet, pervasive, and almost invisible. That company is BlackRock. And with $10 trillion in assets under management, it stands not just as the largest asset manager in history, but as a force that quietly shapes the global economy in ways most investors never see and most governments rarely question. $10 trillion. Let that number settle. It's a sum so vast it defies easy comprehension. To put it in perspective, that amount exceeds the annual economic output GDP of every country in the world, except the United States and China. It is greater than the combined GDPs of Japan, Germany, and the United Kingdom, three of the world's most powerful economies. For an American investor, those 10 trillion are equivalent to nearly 40% of the entire U.S. economy. But unlike a bank that lends money or a government that taxes it, BlackRock does something more subtle. It manages wealth on behalf of others. Pension funds, insurance companies, sovereign wealth funds, college endowments, and millions of ordinary investors all entrust their money to BlackRock through products like exchange, traded funds, ETFs, and mutual funds. The firm deploys the capital across global markets, charging fees as low as 3%. But when the base is 10 trillion, even a fraction of a percent translates into billions. In 2023, BlackRock earned nearly $20 billion in revenue. That scale is not just impressive, it's transformative. And it's only the beginning of the story. Because BlackRock isn't just managing money, it's becoming the invisible hand behind the markets. Take the S&P 500, the benchmark index of American corporate power. BlackRock is among the top 2 shareholders in 495 of its 500 companies. That means it holds substantial stakes, between 6 and 8%, in giants like Apple, Microsoft, Amazon, Tesla, JP Morgan Chase, ExxonMobil, and Pfizer. This is not concentrated ownership in a single sector. It spans technology, energy, finance, pharmaceuticals, and consumer goods. And here's what makes this so significant. BlackRock doesn't dominate one market, the way Standard Oil once did. Instead, it owns every major competitor in nearly every major industry. Economists call this common ownership, and it creates a powerful structural incentive. When a single investor owns a piece of all the rivals in an industry, their interest shifts from maximizing the success of one company to maximizing the stability and profitability of the entire sector. Why push for disruptive innovation if it might hurt your returns across multiple holdings? Why encourage price wars that boost consumers but dent corporate profits across your portfolio? The unintended result is a system where competition is quietly dampened, prices stay higher, and innovation slows, not by design, but by alignment of interests. Now, you might wonder, does BlackRock actually do anything with these shares? The answer is yes, and it happens through proxy voting. When you invest in a BlackRock ETF, like the eShares S&P 500 fund, you technically become a partial owner of hundreds of companies, but you don't get to vote. BlackRock does. In 2023 alone, the firm cast votes at over 16,000 shareholder meetings around the world. Most individual investors don't even know that shareholder votes exist, let alone participate. So BlackRock's block of votes, often 6 to 8%, becomes decisive. It can determine who sits on corporate boards, how much executives are paid, whether mergers proceed, and whether environmental or social policies are adopted. In 2021, for example, BlackRock joined Vanguard and State Street in backing an activist campaign to replace 3 directors at ExxonMobil. These were not shareholders revolting from the outside. This was the engine room of capital itself demanding change. The message was clear. Even the most powerful corporations are answerable to institutional investors who control the votes. And it's this power, the quiet exercise of control through ownership and voting, that begins to expose a deeper flaw in modern capitalism. Economists have shown that common ownership leads to real-world consequences. In the airline industry, research indicates that routes dominated by carriers with overlapping institutional investors have ticket prices 3 to 7% higher than they would be under more competitive conditions. In banking, profits rise, but lending becomes more conservative. In pharmaceuticals, the same dynamic may be contributing to higher drug prices and fewer breakthrough innovations. There is no secret meeting where CEOs agree to raise prices. No cartel. But when the financial incentives are aligned across competitors, the outcome is the same: reduced competition, higher prices, and lower dynamism. And the engine driving this passive investing, the very model that was supposed to democratize access to the markets. At the heart of that model is technology. And BlackRock's Aladdin system is the crown jewel of financial infrastructure. Developed in 1988 after founder Larry Fink lost $100 million on a failed mortgage deal, Aladdin was built to track risk across portfolios in real time. Today, it doesn't just monitor BlackRock's $10 trillion. It manages over $21 trillion in assets, including those of central banks, giant pensions like CalPERS, insurers like AIG, and other asset managers. Aladdin assesses risk, models market shocks, and recommends trades. It is, in effect, the operating system for modern finance. But here's the catch. It's a black box. Its algorithms are proprietary, unregulated, and invisible to the public. When Aladdin signals that a certain asset is becoming too risky, dozens of institutions may sell at once, triggering price drops that can spiral into broader market instability. And because BlackRock both uses Aladdin and sells access to it, the firm stands at the center of a global financial nervous system it helped design, but which no one fully controls or oversees. This level of influence becomes even more concerning when the line between public and private blurs. During the pandemic in 2020, financial markets seized up. The Federal Reserve wanted to buy corporate bonds and ETFs to restore liquidity. But legal constraints prevented the Fed from doing that directly, so they outsourced the job to BlackRock. The firm was hired as the advisor and execution agent for the Fed's emergency market support programs. BlackRock used public funds to purchase private assets, including shares of its own iShares ETFs. It advised the central bank. It executed the trades, and it collected fees, all while boosting demand for its own products. This isn't conspiracy. It's convenience. The Fed turned to BlackRock because it had the expertise, the technology, and the infrastructure to act instantly. But the optics are troubling. A private firm, paid by taxpayers, profiting from policies it helped design. This is regulatory capture in slow motion, a quiet merging of public authority and private interest. And that capture is reinforced by something even more institutionalized, the revolving door between BlackRock and Washington's. Over the years, senior executives have moved seamlessly into top government roles. Brian Deese, former head of sustainable investing at BlackRock, became President Biden's chief economic advisor. Michael Pyle, a BlackRock strategist, now advises Vice President Harris. Adewale Adarimo, BlackRock's former chief of staff, is Deputy Treasury Secretary. The flow goes both ways. BlackRock hires former central bankers, former Fed chairs, former regulators. These are not junior hires. They are senior leaders shaping strategy. The result is a feedback loop where the same people who write financial policy later work for the firms that profit from it, and vice versa. When rules on ESG investing, financial regulation, or climate risk are debated, the voices at the table often have deep ties to BlackRock. And while none of this is illegal, it raises fundamental questions. Who is governing for whom? Nowhere is this influence more visible than in the annual letters from Larry Fink, BlackRock's CEO. These are not mere opinion pieces. They are policy directives cloaked in market language. In 2020, Fink declared climate risk is investment risk, urging companies to disclose their carbon footprints and transition plans. The following year, he demanded action on diversity, equity, and stakeholder capitalism. Companies that ignored these messages faced consequences. BlackRock's votes could sink board members, block executive pay packages, or derail major proposals. With trillions in voting power, Fink didn't just express preferences, he set expectations. And because CEOs know that losing BlackRock's support can be fatal, they listen. But here's the irony. Fink is not elected. He is not accountable to shareholders in any direct sense. He is one executive operating within a private firm, shaping the behavior of hundreds of corporations across the economy. This isn't shareholder activism. It's corporate governance by oligarchy. And the structure that enables this power is, in a word, circular. BlackRock, Vanguard, and State Street, the big three, together manage over $22 trillion in assets. They each own about 20% of the average S&P 500 company. But here's what few realize. They also own significant pieces of each other. Vanguard holds around 8% of BlackRock. State Street has stakes in both. BlackRock owns shares in Vanguard funds through its own investment vehicles. They are intertwined, forming a self-reinforcing network. This isn't a traditional monopoly with one entity in control. It's a horizontal oligopoly, a small group of firms that collectively dominate the system. Antitrust laws don't apply because no single firm holds a majority. But in practice, they vote the same way. guided by proxy advisors, shared incentives, and implicit coordination. They do not need to collude. The system aligns them, and that system is accelerating. For 2 decades, investors have fled expensive, underperforming active funds and poured money into low-cost index funds. BlackRock and Vanguard lead this passive investing revolution. The more money that flows in, the larger these firms grow. The larger they grow, the more ownership stakes they accumulate. The more voting power they wield, the more influence they have over corporate behavior. The more stable and profitable those companies become due to reduced competition, the higher stock prices rise. And rising prices attract even more capital into index funds. It's a self-reinforcing loop. Some analysts project that by 2030, the big three could collectively control the majority of shareholder votes in most major U.S. corporations, not through formal ownership, but through coordination, not through force, but through inertia. The irony is that index funds were sold as the ultimate democratization of investing. Low fees, broad diversification, access for all. But their success has created a paradox. The more widespread ownership becomes, the more concentrated power is. The more passive investing appears, the more active its consequences. The solution isn't to demonize BlackRock. The firm operates within a legal and financial system that rewards scale, efficiency, and integration. But the outcomes, less competition, higher prices, unaccountable power, threaten the very principles of open markets and democratic capitalism. Fixing this won't happen through market competition. You can't out-index BlackRock when the index itself feeds their dominance. Real change will require political courage, rethinking antitrust for the age of passive ownership, giving individual investors direct voting rights, or regulating the algorithms and conflicts embedded in systems like Aladdin. Because in the end, the problem isn't that BlackRock is too big. It's that the system has allowed a single firm together with just 2 others to become the silent architects of the global economy. And when one entity effectively owns everything, capitalism no longer functions as intended. It becomes something else entirely.